For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shade. I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from Randy and Jake Floyd of Floyd Financial Group. Randy, how you doing this morning?
Doing very well, Jeff. How about you?
I'm doing great, thank you. And Jake, how's this Saturday morning finding you?
Doing great, Jeff. Thanks for asking.
Always glad to hear it, you guys. Hope our listeners are having a great day. Excited to be with everybody today because I think we really have a very good show lined up for us. We're going to get back to the basics on today's show. We're going to be talking generally about investments. I'm surprised at the number of people who do not know what investments are, Randy. They think they're investing in an $80,000 automobile, but that couldn't be further from the truth. So let's start off by talking about exactly what is an investment. How would you define that?
Yeah, Jeff, it's interesting what you say there. We're not given in our country here a lot of information on finance and investing. And so today what we're going to do, like you said, is just kind of drill down on this a little bit. But basically, investment is where you put a small amount of time or money into something to hopefully get a return on that over time. So if you put your money into something, you hope to get more money back would be the first thing. Secondly, it could be saying, I want to take this money and I want to place it over here, let somebody else use it, like a bank maybe or a financial institution, in order to get income or to make a profit for the future.
So investment can be two things. It can be both time and money, but the goal here is to get some sort of return on your investment. Now, with any investment, you're taking a risk, but it is a calculated risk. Can you expand on that?
Sure. Every type of situation can be really risky. So let's think about maybe what the ultimate risk would be. Playing the lottery, right?
Oh,
so
yeah.
If you go out and you say, I'm going to invest this dollar and I hope to get $10 million in return.
Yeah.
While your risk of the dollar is probably affordable and not that great, when you look at it from a different perspective, what are the actual chances you're going to get a return on that investment?
I would say that it's probably tens, if not hundreds of millions to one. What do you think?
I would say that you're exactly right. That's why once in a while when this, what is it called, Powerball, I think, that thing is like $4 billion or something, I think. So think about all the dollars that have to go into that to pay somebody $4 billion, and only one person is going to get that. Or sometimes I guess there's two or three. I don't know how that all shakes out. But even so, you can see how that's speculative, right? One of the questions that comes up is, where do I place my money? How do I do that? First of all, why do we invest? Number one, for most of the people we're talking to on this show, they're hopeful that one day they will be able to stop investing their time every day to earn income,
right,
and maybe have amassed enough money to live off of the investments and the returns that they have earned over a lifetime.
Yeah, and what you're saying is really you want to stop working for your money and have your money begin working for you so you don't have to work yourself.
Absolutely. Now, in the beginning, Jeff, we're going to look back over our shoulder here, and a lot of people listening to this will go, oh, yeah, I remember that. So I remember when I could barely pay attention, let alone anything else. It was one of those things where I was just living hand to mouth. I didn't know how I would ever start to save any money,
right,
and really get ahead. And our goals and our desires change, right? So when I turned 16, I could not wait to get my car. So I got my first car, and ding, 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 it was a chartreuse. It was so yellow, it was almost green.
I know.
Glowing 1966 Ford Falcon.
Yeah.
Well, I'll tell you, it was interesting. I paid $300 for that car.
Yeah.
And it burned nearly as much oil as it did gas. In fact, and I'm kind of ashamed to tell you this, and people listening, don't judge me on this. I was young, right?
Yeah, sure.
But I kept a case of oil in the back seat, and when the oil light would come on the dashboard, I would stop and glug, 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 put a quart of oil in it, or maybe two, and then drive until it came on again.
Everybody has those first cars like that, but I remember mine quite well, and I had it for a little bit. Now, I forget what I bought after that, but yeah, that car was absolutely not an investment.
I guess in one way they were an investment because they did get us to our $1.64 an hour minimum wage job,
I
right?
was just going to say that. It got me to and from work and to and from school, so I guess it served its purpose.
Well, that car, when I was a young teenager, I was looking to, find some girls to date, right? And I'm not sure that the Chartreuse Falcon actually won over the hearts
Wasn't helping you?
No,
of any girls. Anyway, it did get me around a little bit. So, yeah, I mean, I think the thing that we need to think about here is at some point in life, and I remember a guy told me this probably 35 years ago, he was saying, so what kind of job do you have? How much money do you make? And he says, so what kind of equity do you have? And I said, equity, what do you mean? Well, he says, what's your net worth? And at that point in time, my net worth was about nothing. And so, why do we invest? Well, we want the idea that at some point we are going to have built equity and we are going to have investments or money or cash or whatever to help us live our lifestyle when we've either gotten to the point where we don't want to work so hard or work at all, or we've gotten to the point to where maybe we can't work anymore.
Yeah, and I think the next question is what to invest in, and a wise man did tell me, and this is for the younger people listening to the program today, the best investment that you can make is in yourself. It's going to be in your education, it's going to be in your tools to allow you to make money, and then after that, it's going to be your principal residence. But once you have got your education, your tools out of the way, and maybe you've gotten your principal residence out of the way, what should we be investing in, do you think, to begin with?
Right. So, there's a lot of investments out there and a lot of possibilities that we will talk about today. I think the most important thing, though, is, and I don't know who said this, but we need to begin with the end in mind. Now, that doesn't mean that the end won't change over time, but, we need to set a goal, and then we need to figure out, okay, how do we accomplish that goal systematically, right?
Right.
Because if we don't do it that way, we're relying on, hitting the home run at exactly the right time, or maybe a couple of home runs over our lifetime at exactly the right time. And for a lot of folks, that just never comes. But there is a plan, and there is a way for people to achieve their goals systematically, and that's one of the things that we'll want to talk about today. We're going to talk a lot about risk and risk tolerance, and we're going to talk about risk versus volatility and things of that nature, which sound like maybe the same thing, but in reality, they're not. They're completely different. And so one of the things that comes up all the time, too, is, well, I am such and such an age. Does that change how I invest and what I invest into? And the answer to that question is absolutely it does. We're going to focus mainly today. We'll talk about some of the youngsters out there that are in their 20s, 30s, 40s, and 50s, but we're going to talk about a lot of the people that are probably 55 and older and where they are. And if you're in that 30, 40-year age category, hopefully you'll pick up a few things here that'll help you to achieve your goals when you're hitting the age 60, 65 for retirement.
And the strategy that I've used many times, and you just described it, was reverse engineering. Come up with a goal that I want, then reverse engineer a way to get there. So anyway, you can indeed do that with investing. Talking with Randy and Jake Floyd of Floyd Financial Group. We're going back to the basics and talking about investing. What should you invest in when you're first getting started as far as investment products go?
Yeah, I think one of the big questions that comes up for everybody is risk. I'm afraid to invest here because of the risk, or I don't understand what risk is. And also this thing called volatility. So the market goes up, the market goes down. People say, well, Randy, is the market going up or is it going down? I'm saying both, because it always goes up, it always comes down. But traditionally and historically, and probably even extrapolated into the future, we're going to see that investments typically are going to go up long term. So what's the difference between risk and volatility? So let's think of it this way. What's a big company, a big tech company? Let's talk about one that's been around forever, Microsoft.
Right.
Everybody knows who Microsoft is. Talk about a great business model. Here comes this guy, says, hey, you know what I'm going to do? I'm not going to sell these people this software. I'm going to license them to use it and charge them for it over and over again into perpetuity.
Oh, yeah. So frustrated today because now all you can do is rent it.
Yeah, Randy, that sounds like something Mr. Wonderful from Shark Tank, Mr. Kevin O'Leary would like. He loves the word perpetuity. I think that might be his favorite word.
That's the thing. Microsoft is probably not going out of business anytime soon. Can we all agree on that?
I think
Well,
we
I mean,
can.
when you sell air for billions of dollars,
That's
it's
true.
it's
That's
pretty
right.
good.
That's true. So even though Microsoft is not going out of business, I would say that if you look back over your shoulder, there would be some serious volatility, ups and downs in their history, right? So if we were to look out there over the last 10 years or whatever, they've had a lot of ups and downs. So they had volatility based on market conditions and what was going on with interest rates and things happening around the world and global pandemics and all those different things. But the risk of Microsoft going out of business and you losing your money as an investment was very low. So I like to explain that difference between risk and volatility for people, because some people think that as soon as the market has a downturn, it's the end of the world and they're going to lose all of their money, and it's just simply not the case. And so one of the things I need to talk about also that has just kind of come up that's really not in our notes today, Jeff, at all, is this. When people are looking to initially invest, you're never going to be able to see the end of how things are going to come out. But here's how business gets done. We've all heard of these. We've probably heard the term investment bank.
Right.
So an investment banker, what do they do? So Merrill Lynch is an investment bank, Goldman Sachs, JP Morgan Chase, those people are investment bankers. And so what they do is, let's say you and I form a company, Jeff, and we go out here and we do pretty well and we have a great business model and we want to try to expand that business. But guess what? We don't have all the capital required to go do that. So where do we go to get money? Well, we can go to the bank. And a lot of people listening out here, have you ever tried to go to the bank and borrow money when you really needed it?
Yeah, I can borrow all I want when I don't need it, but when I need it, it's a little bit different story.
It's exactly right. You really, really can't get any money when you really need it. So the investment bankers, what they do is we would go and we would make a presentation to them and say, this is how our business model works, this is the profitability, this is how it works, and this is why we think the market's out there and we want to expand. They're going to look at that, they're going to make their assessment, and then if they like it, what they're going to do, they're going to take it to a small section of their key investors and say, hey, here's an idea, would you have any interest? They try to generate some interest in that. If they can generate interest in that, they do what's called an initial public offering. And that initial public offering says, hey, here's a business idea, and everybody can take a little bit of their money and invest here, which collectively makes a big pile of money for us to go and build our business. Now, here's the key. It doesn't mean that our business is going to be 100% successful every time. But what it did do is it allowed people to have a little chunk of our business, if you will, as that business grows and expands, and they get a return for their small investment, which is kind of what we talked about in the very beginning of this talk today, right? So then, let's say our business goes out and it grows big like a Microsoft. Okay, so over time, there's millions and millions of shares and millions of owners. Everybody profits as the company profits. And let's say that the day comes, Jeff, where you need some money out of your retirement account, and so you want to liquidate a little bit of your Microsoft stock to get income or to get some money into your bank account. Well, that's what's called trading on the secondary market. So the secondary market is the markets we watch every day. The NASDAQ, the S&P 500, the Dow Jones, the Russell 2000. All those are indexes that track markets and track companies inside the stock market. So it's one of those things where once you kind of understand how it happens and why the public markets exist, people say, well, how do we know the stock market's always going to exist? Well, how else are we going to fund business? How's it going to get done? There really is no other way, and we spread the risk, and people can then take the risk that's appropriate for them. And that's kind of where we come in at Floyd Financial Group, is helping people to assess risk, understand their risk, what they're trying to accomplish, and manage all those things together to get them a final outcome.
We're talking with Randy and Jake Floyd of Floyd Financial Group. We're talking about generally investing in our program today. If you've got questions about what we talked about, you want to get in and sit down with Randy and Jake and maybe have a private conversation about your investments and building your portfolio, we're offering you that opportunity right now by calling 417-889-7233 and requesting your Floyd Financial Group retirement review. It won't cost you anything, certainly, and there is no judgment and no obligation. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. And remember, this one call could make all the difference. Time for a break, Randy and Jake. When we come back, we'll continue our discussion about investments. In particular, we'll talk about what an investment portfolio should consist of when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about what should a person's financial portfolio really look like, and is it different for each individual?
I think it is, Randy, and I want you to expand on that. There are a lot of elements that could go into a financial portfolio. Of course, your risk is going to determine what those are, but let's start at the beginning here. What should we put in a financial portfolio to give us sort of a groundwork or a basis to build on?
Sure thing. So, number one, your age and your time horizon are going to be the first things that come into play here. If you're 25, your goals are much different than if you're 55. And your time horizon obviously is much different too. The biggest thing is, let's just really start with a baseline. You remember the old food pyramid that says, hey, you need grains, you need meat, you need berries and all that. So it built the pyramid. Right. Well, your financial pyramid should look something like this. First and foremost, before you start investing, you probably need to have a checking account that has a balance in it that will keep the wolf away from the door each month. And then if you have a few extra dollars, even a very few extra dollars, we can start to invest. But you got to have a checking account, and you need to have that to where as you write your bills each month and you're taking care of whether it's your car payment, your insurance payment, your rent payment, whatever it is, you got enough money that's sufficient enough there to where you can really not worry about bouncing checks, right? And then secondly, we need to have an emergency fund. Now, the emergency fund can be in a savings account or something like that. The checking account's not an investment. It's just something that you need to make your life work, right?
Sure.
But the savings account or the emergency fund probably needs to be somewhere between 3 and 6 months of your bills. Because let's face it, life today is uncertain. Like right now we have across the globe, we have a lot of companies saying, you know what, post-COVID, it's time for you to return to the office.
Yep.
Now, there's a few people that made the mistake of moving cross-country because they thought they were going to be able to work remotely for the rest of their life.
Right.
And now the company says, hey, it's time to come back. And here they are, they're stuck. So they better hope they have a 3 to 6 month fund out there on the side.
You bet.
So that they can not have to stress and move back in with mom and dad.
Yeah.
We need to have that emergency fund out there. Then we can really start talking about investments. So is a home an investment? Yes. A home is a good investment because over time it tends to appreciate, not depreciate. It's important, though, that as you start to buy a home, that you look at what your situation is and be sure that you don't overbuy and put yourself in a situation to where you won't have an emergency fund and you can't keep your checks from bouncing, right?
Right.
So the next thing is, maybe it's a college tuition plan that you have. If you've got youngsters, you need to think about that and what you want to provide for them. Not that you have to fund all their college, but it's something that you should think about and have a plan for that. Now, everybody's situation is different. I want to be clear on that. Everybody's situation is different. What kind of car you have, when I was 16 until I was about 25, man, a car was everything to me. I had more cars than it was.
Me too.
It was crazy. I look back and I think about the money that I wasted on those cars because I always bought them for a higher price than I sold them for, right? And then went and bought another one.
Absolutely.
And I remember one time, back when I was probably in my early 20s, I went and I bought this car, and then I wanted this other one, and I was upside down.
In the first one?
I owed more on it than it was worth.
Oh, my gosh.
And so I had to go out and get cash to
Pay it
get
off.
out of the one car to get into the other one, and then I had all this huge payment. So
Yeah.
anyway, I know I'm not talking to most people listening here today, but I remember those days.
We've all done that sort of thing. I mean, it was just insanity, one after another, and it took me a lot of years before I discovered that really a car can be just a tool, that it isn't who you are. But a lot
Right.
of people, even to this day, do not know what a car is really intended for, and they think it is an investment.
For sure. So once you get your, you get your checking figured out, you get your savings, your emergency fund figured out, and you're kind of settled in, maybe the college tuition if you're thinking of funding some stuff for college. Now, and you got your home, now we can probably sit down and say, okay, let's start thinking about investments. So number one, first and foremost, if you're working a job, a 401k or a 457 plan if it's a government job, or the SEP retirement plan, whatever it is that your employer is purporting, if there's a match, you need to at least put that amount of money in, because free money is always good.
Yeah.
The 401k is the basis for those people working right now. Get involved if you're not. Talk to someone that you trust about finance that can help you make some choices in that arena. Most of the time when you start in those plans, that money's going to be in there long term, and that's good because we need the compounding effect of long-term investment. What did Einstein say was the eighth wonder of the world?
Yeah,
Compound
Yeah.
interest, right?
Right.
And it's really true, and we're going to look at an example of that here coming up pretty quickly here. But, that's the first thing to do on the investment side. Then if you want to get outside of the 401k and start investing on your own, we need to probably look at what are some of the investment choices. And when I say investment choices, are we looking at retirement accounts, savings accounts, CDs, those sort of things? And we're going to talk more about all those type of investments here a little later in the program today. But again, we need to be thinking about investing outside of that, and what is our time horizon for money that we're saving and investing right now? Is it that retirement date of 30 to 35 years? Or maybe you're somebody that's listening today and you're just hoping to save enough money to go buy your first house,
Yeah,
right?
right.
So whatever it is, we need to think about what the time horizon is. And when you go out and you buy cars and you buy homes and all that sort of thing, my dad used to say this. My dad was not a very educated man, but he was educated through life, and learned a lot. And he said, Randy, he said, you need to use reason in all things. And he didn't say it that way as a country boy. He'd say, Randy, they is reason to all things, as he would point his crooked little finger at me.
Yeah.
So
I can just
So-
see that, yeah.
he was right, and there certainly is. So I guess the biggest thing we talk about now is, where do we start investing in, and based on our age, how does our risk tolerance and our appetite for volatility change? The younger we are, the more time we have, and generally the more aggressive that we can be. And the closer we are to retirement, the more we want to be protective of what we have earned so far. So today, I think what I want to do is just really start talking about what are the different types of investments that are out there. And I'm going to just list them here, and then we're going to go back and we're going to talk about each one of these in a little bit of detail. So number one, we have banks, right?
Right,
So everybody
right.
knows at banks we got savings accounts, money market accounts, and CDs, basically. Then we have insurance companies that produce things like cash value life insurance policies and annuities and that sort of thing. Then we have the stock market, and there's so many categories within the stock market as to how you can invest. We're going to kind of enumerate those, okay? And then there's the bond market, which is basically the opposite of the stock market. The stock market, we own equity. Bond market, we own debt, right? Then there's commodities, everything from pork bellies to gold, right?
Right.
And then we have alternative investments, things that most people haven't even heard of. Then we have real estate, either directly as we own real estate or indirectly through real estate investment trusts and that sort of thing. Then we have derivatives of the market, which is a whole sector of in itself. And then we have this thing called private equity. So private equity is one of those things that's grown a lot over the last few years, but there's some inherent challenges with it. So those are all of the different types of investments. I'm just going to go back and we'll just start talking about item number one, the banks.
Right. Okay. So we've got our bank, as you said. A lot of people think it's just a checking account, but they do have savings accounts. They do have a lot of safe investments. But the downside to the bank is that they really don't pay too much in terms of interest. There's really a lack of growth there.
Well, yeah. So for most people, when we think of the banks, we think of those as the ultimate safety blanket because we have the FDIC, the Federal Depositors Insurance Corporation, that backs up our deposits up to $250,000. So we know if we go over there and we put our money in a savings account and they pay us 1%, today with the fact that Jerome Powell, our Federal Reserve Chairman, has, had interest rates up to 5.25%, 5.5%, but they're starting to come down now. But we've had some really decent bank rates on money markets up around 4.5%, maybe even 5%. We've had CDs at 4.5% and 5%. That's going to start to come down. So, but, if we look back over our shoulder go back 2.5 years now, about 2 years when Jerome started raising rates, we were at zero. Banks were paying basically 0.2% on money market accounts. A lot of them they were paying 1% on even longer-term CDs. So while it's ultimately be very safe, it's going to be very hard to compound your money and make a lot of money. There's a rule that we should talk about that will help people to understand interest and that sort of thing. So there's this thing called the Rule of 72. Mm-hmm. So, Jeff, the Rule of 72 says this, if I want to know how long it takes my money to double at a specific interest rate, I simply take 72 and divide it by the interest rate, and that's how many years it takes for my money to double. So if I'm getting, now think about this. This is going to really shock some people here in a minute. Uh-huh. If I have a 1% CD, how many years does it take my money to double? 72 years.
Yeah, I was going to say, who has 72 years?
Nobody has 72 years except maybe the baby that was just born, right?
Right.
So next, if it's even a 6% return divided into 72, it takes 12 years for my money to double. Right?
Yeah,
if I get a 9% return, it takes 8 years for my money to double. Therefore, 7.2%, our money doubles every decade, right? Mm-hmm. So when we start looking at it from that perspective, it all of a sudden is going to change how we look a little bit more at risk and volatility. Because, like you said, nobody has 72 years.
Yeah.
And the Federal Reserve is going to push rates back down. They have to, because we have to refinance our debt as a country. So banks, while they're great and they serve their purpose to have emergency funds where you can lay your hands on them easily, to have the checking account so that you can pay bills and have a debit card and that sort of thing, great things. But banks are primarily there to help us with those sorts of things and providing a mortgage, and they're going to get paid their 1.5% to 2% spread on loans as a minimum, like on home loans and things, and much more on cars and credit cards. They provide those basic services that we need, but make no mistake, they're not there to help you get rich.
We're talking with Randy and Jake of Floyd Financial Group, and we're talking about investing. We're covering all the basics for you. We've been talking about why you invest, where to invest, and we've talked about banks. We're going to continue this conversation in just a moment. But in the meantime, if you've got questions about anything that we talked about today, you want to get in and sit down with Randy and Jake at Floyd Financial Group, talk about your individual journey towards a confident retirement. You can get that started by calling 417-889-7233 and requesting your Floyd Financial Group retirement review. It's just a casual conversation. It's a no-tie zone, no cost, no obligation, and no judgment whatsoever. So go ahead, make that call right now. I know it is the weekend. Leave your name, telephone number. Ashley will call you back during the week and set up that appointment for you. Again, no cost, no obligation, and we'll meet you where you are. We would love to meet you, so give us a call, 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Time for a break. Randy and Jake, when we come back, we'll continue our conversation about investing basics and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and continuing in financial investment vehicles. We started with banks. Number 2 is going to be insurance companies.
And Randy, I think insurance companies certainly have some investment options to them. The upside is that they're relatively secure, but I think the downside is there's a limit to growth. Am I right or wrong about that, or is it somewhere in between?
Yes and no and in between.
Okay, I'll let you take it from there.
So basically, for insurance companies, I mean, I'm not talking about property and casualty. You know, obviously, you can own insurance companies as an investment. But that's going to be more of a stock type position. But here's what I would say about insurance companies: they do cash value life insurance contracts, and they also do annuity contracts. So we're going to talk briefly about those. So cash value life insurance is one of those things that's been around for a very long time. What basically happens is if you buy a life insurance policy that has an investment option on it, so you're going to pay your cost of insurance plus the money that the insurance company needs to make and some extra that can be invested either directly in the market through a variable life insurance contract, or you can tie it to an index where you don't have any loss, but you only have upside gain potential. So those are the really basic tools that we want to talk about here. So let's talk about variable life insurance. Basically, you pay the premium for your life insurance benefit. You pay some extra money in with that premium each month, and what it does is it goes into an investment portfolio, and then if the investment portfolio does good, that adds to the cash value inside your contract. So I have seen these situations where they can be very good and not so good. And the thing is, the insurance company, yes, they do make money and make a spread on your money. But let's go back to the very beginning. Anybody that you invest money with is going to make a living. Everybody gets paid. In capitalism, everybody gets paid or nobody gets paid.
Right.
It's really kind of how that works, right? So it's not a dirty word for people to make money.
No.
And obviously what you want to do is you want to try to set yourself up in a position where you can make the most amount of money and do everything properly and fairly, right?
Right.
So the insurance companies, the thing I love about the insurance companies is they tell you exactly what they will do, and then they're held to the letter of doing that. And so a lot of people say, well, I don't like that. Well, if you don't like it, don't buy an insurance contract. But just know this, that what's good about insurance companies is they will do exactly what they say. And they won't do one thing more or one thing less. So that's kind of a good thing, really, because sometimes things in life are a moving target and we don't know what that is, right? So there's good choices and bad choices there. There are indexed products that the insurance companies do that give us the ability to profit if a market index does good, but if markets go bad, they don't lose money. And the reason is they don't actually own a stock market position. They own an option, a call option on the market that allows us to profit when things are good. But if things are bad, all that you give up would be the interest that the insurance company would have paid you, maybe 1 or 2 or 3% in today's world, versus maybe many multiples of that if indexes do well. And I'm talking like the S&P 500, the Dow Jones, the NASDAQ, those types of places. But are there places and good uses for cash value life insurance and variable and indexed annuity products? The answer is yes, depending on what a person's risk tolerance are, where they are in life, age-wise, and, just what their overall emotion is tied to volatility in the stock market.
And those index products, Randy, like you said, you have a cap many times. If the index is up 10, you might get 7. But I do like the fact that you do have a floor of 0. You can't lose money on those.
Yeah, absolutely. So are there good products out there in every category? The answer is yes. So let's move on, number 3, to the stock market. Now, this one here is going to get a little bit weedy, but I want to try to keep this boiled down and keep it as simple as possible. So there's 2 ways that you can actually obtain stock market performance. One of those is indirectly through call options and things in an index, and then also directly by being directly invested in the market through several different vehicles. And those vehicles are what we want to talk about and focus on primarily in this section. So number 1, you can go out and you can buy an individual stock. So if you were going to buy an individual stock today, Jeff, what would it be?
Well, for me, I don't know. Maybe I'm going to join their herd and buy something like NVIDIA.
Okay, so NVIDIA is one of those that, with AI and all that, in the last 5 years, that stock has appreciated 2,600%.
Right.
Now, while that is definitely... That's not a home run. I mean, that's a trip to Mars and back.
Yeah.
I mean, you hit it way out of the universe on that one.
But I'm thinking that it may have more room to go. I don't know.
And it probably does. It does. But for the sake of argument today, all we want to do is we want to point out you can buy stocks individually. And this is probably the least expensive, not probably, it is the least expensive way to own stock. Now, there's a couple of different setups. You can buy stock either through a broker or a brokerage account or through a registered investment advisory firm. There's 3 different ways to do that, and each of those have different setups, and we won't get into those specifically right now. But you can also buy stocks through what's called a mutual fund.
Right.
So a mutual fund is many times, that's what's inside most of the 401k and the IRA type accounts that are out there today. So a mutual fund is a grouping of stocks and or bonds. Bonds is where we own the debt of a company. And there's a manager or managers that look over that and manage that. Now there's a common misconception out there in the general public, and that is that if I own a mutual fund, I don't have any risk. There is systematic or systemic risk in ever owning a stock. Now, that risk can be either high or very low. As we talked about earlier, the chances of Microsoft going out of business tomorrow are pretty slim. Mm-hmm. Other companies that have recently gone out of business, not the case. And as my dad used to say, every dog has its day. Eventually, the Walmart will eventually become Kmart if time lasts, right? So it's one of those things where mutual funds, while they had a great place way early on of spreading risk was the idea, and really have proliferated through the advent of the 401k starting in the mid-70s till today. There are other vehicles that look similar to mutual funds where they're a grouping of stocks, but they don't have a manager, and those managers get what? They get paid, right, Jeff?
Right.
They do. So mutual funds have an expense tied to them that individual stocks do not have, and they also have a larger expense tied to them than most of the exchange-traded funds. Now, there's some exceptions to that, and we always know this, there's exceptions to every rule. Mm-hmm. So today we have exchange-traded funds, and they look like a mutual fund on the surface because they're a grouping of stocks or bonds, and they look very, very similar. But you can always tell because they have that ETF label attached to them versus the mutual fund just having a ticker symbol many times. So the ETF many times too also follows market sectors. So what do we mean by market sectors? So when we go to the grocery store, at my local Walmart neighborhood market, we walk in the door, we turn right, and there's the produce section.
Right.
And then if we walk on down a little further, we got the dairy section. And then we got beverages. So think of it this way. The stock market is divided up into 11 sectors. So that's like technology, financials, consumer staples. That's things like coffee and tea and deodorant and razor blades. Okay, and then we've got, real estate. We got consumer discretionary. That's things like hotels and cruises and things of that nature. But suffice it to say, there's 11 market sectors. And the ETFs in their purest form tend to mirror those, but there's many, many variations. But again, the cheapest way to own stock is individual. The second way is through a mutual fund, which is what most of the 401ks are. And then there's ETFs, and there's a few 401ks starting to have ETFs inside them, but not that many. Again, the most risky way to invest in the stock market is to go out and buy one stock.
Right.
So if you go buy one and that one blows up, guess what happened to your money?
Well, it
blew
all
up.
blows up
right?
too, I guess.
So the mutual fund, by spreading risk, was a good way to look at taking that single stock risk out of play. The ETF is also another way to do that. And then finally, the last thing I want to talk about on the stock market is options. So options are one of those things that most times when people hear that, it's kind of like who was the lion on the Lion King?
Mufasa.
They go, ooh. And then they would go, ooh. So when you think of options, that's kind of what people do. And there's lots of different ones. And yes, there are some that are absolutely the riskiest thing you can do, and they have unlimited loss potential. But there are other options that are really quite benign if you actually own the underlying stock that you're playing options on. So those are the categories for the stock market, and I would tell you that I think in today's world, if you have the option, in 401ks, many times you don't have. However, I will tell you more and more, we're seeing that 401ks are offering the opportunity for clients to step outside that 25 or 30 mutual fund offering and get into a situation where they can manage their money on their own, which sometimes we can help people with as far as how to structure those assets. But I would say this, that everybody needs a blend of at least individual stocks and ETFs. I'm not a big fan of mutual funds for a couple of reasons. There's some tax purposes if you have mutual funds held outside of a retirement account. The other thing is, the mutual fund manager doesn't know what else you're doing and really can't help you to form a cohesive plan to get you where you want to go if they don't know. And let me say this secondarily, they are not going to consider your position about one thing they do inside that mutual fund. They just won't.
So if you're investing into the stock market, Randy, as you said, there are mutual funds. Those are a collection of different types of stocks. But let's say that we want to do it ourselves because we have more knowledge about where we are and what we want to do. Obviously, I think leaving it to a financial advisor such as yourself would be better. But how do we vet individual stocks? How do we know which stocks are going to be going to the moon, which stocks are overvalued, and which stocks are just basically, I'll say this, dogs?
Well, you can buy research. You can do your own research. You can listen to your neighbor, or your brother-in-law, or you can go to a financial advisor. So the question you ask is really, it's more complex than people understand. There's a lot of things that happen. Interest rates go up, interest rates go down. That affects how the markets play out. The thing that we never know, and this is the interesting part, we know cause and effect, but we don't know timing of that cause and effect. It's kind of like, this last time we had interest rates really low and interest rates went really high, we knew that the effect was that the market would be down. And sure enough, when Jerome Powell started lowering interest rates in March of 22, for the rest of 22, we had a negative market. We were down 19.40% for the year. Then, we thought at the first of 2024 he would start reducing rates. He didn't, but he stood pat where he was, didn't move. And then all of a sudden he lowers 50 basis points. The market predicted that ahead of time, and the market went up, and we're at all-time highs or near them right now. So there's always the things that we know that precipitate change and outcomes, but we don't know the exact timing. So we have to make sure that we build portfolios that buffer those events that we know are inevitable, they're going to come, and looking forward based on situations with interest rates and who's blowing up who around the world and all that, we have to build portfolios around safety, especially as people get closer and closer to retirement.
The topic of our show today is investments, and we're breaking it down with Randy and Jake Floyd, Floyd Financial Group. Again, based on our conversations today, more than likely you may have some questions about your investments. If that is the case, give us a call here at Floyd Financial Group to schedule your no-cost, no obligation, no judgment financial review. Our telephone number, 417-889-7233. You can make that call this weekend, and all you've got to do is leave your name and telephone number. Ashley will call you back during the week and set up that conversation. It's not going to cost you a dime, and again, no obligation. Certainly there is no judgment. As always, we will meet you where you are here at Floyd Financial Group. We'd love to sit down and talk with you. So go ahead, make that call this weekend, 417-889-7233. Why don't you go out to the web, check us out at floydfinancialgroup.com. Time for a break. Randy and Jake, when we come back, we'll continue about tools that are available to most everyone as far as investments go when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about, or we're going to be continuing in our investment options, and we're at number 4, the bond market.
And how does the bond market differ from the stock market, Randy, in a very big way? Correct me if I'm wrong, but with the stock market, you're buying equity, but with a bond market, you're buying debt, right?
That is correct. That's exactly what you're doing. So a lot of people know the fact that we as a country have $35 trillion in debt, and all that debt is out there in bond form.
Right.
So basically, the government has issued debt so that we could fund our overspending. And they have said, well, because we're overspending and we need this, we're going to go ahead and pay you interest on this for the next 5 years, 10 years, 20 years, 30 years, whatever that bond length of time you bought was. And then at the end, we're going to give you your principal back. So the debt of companies, the debt of governments, banks can also, a CD is a form of a bond in reality. The bank says, hey, we're going to give you such and such interest in exchange for keeping your $10,000 over here for a year. And then at the end, we'll give you your money back. And sometimes they'll pay interest quarterly, sometimes every 6 months, or sometimes just at the end of the term. But basically, you're right. The bond market is the debt of a company. And so when we look at the debt of companies, rather than looking at what their performance is as a stock market or something, we have to look at what is the liquidity, what is the efficacy, if you will, of the particular company or government that has issued the debt. And so we have credit ratings from AAA to basically F and everything in between. And so when we hear the term high yield bonds, those have also been called affectionately junk bonds because they are of lower credit rating than the AAA.
So if we're buying debt, this company's in debt, we're loaning this company money, how do we get paid? How do we know that they're ever going to get out of debt?
That's why we look at the credit worthiness of the borrower that we're lending to, right? So what was it, a couple of years ago, Jake, we got downgraded, maybe 4 or 5 now, as a country. The Standard & Poor's said, hey, we're going to downgrade the U.S. as a creditor.
I think it was on the back of COVID, so about 4 years.
So that's one of the things, and then we have a lot of countries around, a lot of debtor nations around that couldn't pay their debt. I think Italy was one, Greece was another one that had to refinance and reconnoiter and do all that stuff over again. So we want to be careful when we buy bonds. We want to make sure that we know who the issuers are and what the credit rating is. And so we do a lot of analysis here, looking behind the scenes as to what's the timing, how long do these bonds run? Are they 5 years, 10 years, 30 years? Are we looking at A-rated creditors? Are we looking at C-rated creditors? What are we looking at there to make sure that we don't get too much exposure?
Randy, what are the different types of bonds? I've heard of municipal bonds, but what are some of the other types?
So municipal bonds are those, that we have around town here. Like a lot of people know where Chesterfield, the workout and pool center is. That was a type of municipal bond, and it's called a revenue bond. And what the city of Springfield did, they approved building that. And then the people that go there and pay their membership fees pay back the bond amount plus interest to the people that invested in that municipal bond. So that's one thing. The government bonds, and there's U.S. Treasury bonds. There's bonds that are out there for mortgages and that sort of thing. So, the list is long. In fact, the bond market is much larger than the stock market overall.
Okay, so we've got a lot to go here on our program. We've talked about the bond market. Let's move on to commodities. When I think of commodities, of course, for some reason, pork bellies always comes to mind, but you're saying that it's a lot more than just pork bellies.
Oh, yeah, it's pork bellies, it's cattle, it's wheat, it's corn, there's all these things that come into play. And, commodities are one of those things that they can be very volatile, depending on what's going on weather-wise, what's going on, like right now, Ukraine, right? So Ukraine supplied a lot of grain around worldwide as an export, and, their exports are down, and that created a big spike back when Russia first went in there. I haven't looked at what that looks like right now, but commodities are those things that are very volatile. Can you make money there? Yes. Are they for most people? No. Now, gold obviously falls inside the commodities as well as silver and a lot of other precious metals. But I would say this, that commodities are one of those things that the average investor needs help probably understanding that. And so we won't go much further into commodities, but just know that that is an option.
Okay, so the next one on our list is going to be alternative investments. What's involved with alternatives?
So alternatives are those things that they're just not mainstay. Like we have these things called direct participation programs. So a DPP basically comes out, this guy says, hey, I've got a great idea. I've got a shoestring of an idea many times is the way this works. And he writes up a subscription agreement that he gets approved through FINRA and maybe even the SEC, or at least the state that he's doing business in. Many times it's an unregistered security, or can be. And then he goes out and he tries to attract people to invest. And one of the biggest problems with most of these things is they are generally more risky. And if you want to get out, you got to find the next buyer. So we don't really do a lot in this area, but it's something that needed to be mentioned.
Okay, the next buyer, and I think there were quotes around buyer. I'm not going to say what they very well could be. Another word that you could put in there for that. But it's somebody who maybe has an idea. It may not be, completely fleshed out, but it does possibly have some legs, and that is one example of alternative investments. So let's move on to the next one. Real estate, rather a broad territory. There's active and passive real estate, so let's talk about that.
Yeah, so active real estate, that's kind of where you buy maybe a rental property, or you build a shopping center or something like that, and you're running the rents and everything like that. Or maybe you just bought a farm and you're holding it, waiting for it to appreciate over time. And then there's the public trading of real estate investment trusts, sometimes called REITs. And there's public and there's private. The REIT space is something you really need to be careful on, just like direct participation programs. REITs are generally limited to 10% of one's investment portfolio by law, and the reason is because many times they are very illiquid and you have to find the next buyer for those. So if the government thinks they have to step in and limit what people can buy, probably tells you what you need to know about the risk quotient there. Now, I'm not saying that going and buying a farm or buying a house or buying a rent house on your own is necessarily all that risky, but I'm talking about some of the REITs and things that I have looked at over the years. There's a few of those that go public and do very well, but I would say that since the late 70s and even through the 80s, most of those companies, you pretty much just got your money back over a 10-year period plus a little.
You especially want to be careful of REITs that use leverage to buy more assets. Warren Buffett famously said that leverage and derivatives are financial weapons of mass destruction and caused the 2008 downfall and all that. And so I think that's very true. And some of these REITs will leverage the money they bring in to buy 50% more, maybe even 100% more assets than they actually have money for. And that significantly increases the risk inside the investment. So if you're entertaining looking at one of those, just keep an eye on the leverage factor.
Most of our listeners are retirement age or maybe a little bit more than that, so passive real estate is something that they may want to look at. But active real estate, if you're a little bit younger, buying rental properties and so forth may be the way to go. But of course, there is a lot of labor that goes into those things. So real estate is one of those things that you really have to look carefully about. Let's move on to our next investment category here, Randy, and those are derivatives. What are derivatives?
So we talked a little bit about derivatives back in the stock market area there where we talked about options, but there's other things out there like consolidated mortgage obligations, consolidated debt obligations. Those were the things that blew us up back in 7, 8, and 9, where they were over-leveraged, overbought, and they were also sold as something they weren't. They were not A paper. They were subprime mortgages. They were not good mortgages. Subprime means that less than desirable is kind of how I would say that. So you have to be really careful in that area as well because you may be able to get it in something that you can't get out of without losing your shirt. Careful on the derivatives. Most people would need to have somebody to help them if they want to get into the options market, if they want to get into those sorts of things. Unless they've got some experience in the past, I think they need to be careful there.
Last investment category I want to talk about, Randy, is going to be private equity.
So private equity is a whole separate thing. Blackstone is one of the largest, maybe the largest private equity fund investor. And basically there's a lot of, here of late, not so much until COVID time really, did we have a lot of pension funds like California Pension Fund and a lot of pensions across the country invested into private equity. The challenge with private equity is once you get it in there, there's not that many buyers for it. And if you want to get out as an individual, you're going to have to find your own buyer to relieve you of that position that you've taken. And most retirees I just don't think really have any business there because we don't know what's going to happen. I guess if you're somebody and you got $10 million and you can live on $200,000 a year, you might be able to put some of your money in private equity. It might make sense. But for the average person out here, I just don't know that private equity is a good spot for you just because of you don't have any control over it, number one, and number two, it's pretty much illiquid for you.
This all brings me to our investment goal, Randy. I mentioned reverse engineering an investment strategy to get you to a goal. So how do we determine what our goal is? A lot of people say, well, I need $1 million to be secure in retirement. Is that necessarily true today?
So here's the thing, everybody's situation is different. You need to look at what your Social Security income is going to be. If you're lucky enough to be one of those that still has a pension, you got to factor that in. And then you can look at your savings, your 401k, and all your investments to really determine what your total nest egg and what your income is going to be. But let's just say, to kind of give people a handle on this, let's say that you want to have $1 million in your 401k or your IRA or your investment portfolio when you get to age 60 or 65. What does that look like, and how much money do I need to save, and what if I start early versus if I start late? How much difference does that make? Well, most of us are going to work at least 35 years. So by the time we get out of college, let's say that we're 22 and we work 35, we're only 57. If we don't find our career, let's say until we're 30, and then we work 35 years, we're 65, right? So if we wanted to have $1 million, I wanted to kind of paint this picture for people. And then from here, and if you want to have a conversation about this, we can certainly help you engineer a plan that'll get you to where you want to go in retirement. But If we look at it over 35 years, if we take $430 a month, and I said, why did I pick $430? Well, there's 4.32 weeks in a month, right? So you figure at $100 a week, you're going to pretty much fund $430 a month. If you did that for 35 years at a 7% return, you end up with $1,056,000 in your portfolio. Is that enough? I don't know, but here's what I would say. We look at income and what kind of incomes can be derived from that as somewhere between $40,000 and $60,000 a year in permanent income. And you might be able to stretch it a little bit beyond there, but if you don't want to spend your money down, you're going to be living within those guidelines. So at $1 million, it's between $40,000 and $60,000 a year in income that you can have off that, plus your Social Security. Plus, again, if you're lucky enough to have a pension, that kind of helps you to arrive at where your income is going to be. And then we got to look at the taxability and everything of it and how that's all broken out. But that gives people kind of a place to start. But one of the things that we love to do here is help people plan for retirement, plan their income, plan their strategy, see them through if they're within 5 or 10 years of retirement or closer, whatever it is, but help them to structure a plan that we know is going to work for them long-term in retirement and help them to live out their retirement days comfortably.
This has been a very valuable conversation that we've had today, Randy and Jake, about investments, how to reach your investment goal, how to invest, how much to invest, where to put your money. If you missed any part of the program today, I encourage you to seek us out as a podcast. We make all of these shows podcasts, and you can simply go to wherever you get your podcasts, search for Show Me the Money with Randy and Jake Floyd. Certainly, you're going to find this show and many, many of our past shows so you can stay on top of your journey towards a confident retirement. Once again, if you'd like to get in and sit down with Randy and Jake and talk about investing and reaching your investing goals, how to do that, where to put your money, I highly encourage you to give us a call here at Floyd Financial Group this weekend, 417-889-7233. We'd love to sit down and talk with you and help you sort of like a Sherpa to climb that retirement mountain to get to the top. So once again, 417-889-7233. There's no cost for this at all. So make that call this weekend, 417-889-7233. And while you're at it, go out to our website. It's a very, very comprehensive website. Check us out online. See the faces behind the voices at FloydFinancialGroup.com. It's FloydFinancialGroup.com. Well, Randy and Jake, boy, what a great show we have had today. I'm really proud of the work that we've done, but our time is up for this week. So for Randy and Jake, I'm Jeff Shade. Have yourself a great weekend here in the Great Ozarks. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.